Welcome to Work It, Live It, Own It, a show that explores how to upgrade your lifestyle through life lessons, real estate, and entrepreneurship. Here's your hostess, SaCola Lehr. Hello, everyone, and welcome to this week's episode of Work It, Live It, Own It. I'm your host, SaCola Lehr, and we're going to cut to the chase today. We're going to cut all through the red tape because we have an incredible guest, Shauna Wekherlien, a seasoned accountant with a passion for not just crunching numbers, but transforming the lives of entrepreneurs. And how does she do this? Well, with a track record of saving over $1 billion in taxes. Let me say that again one more time. Saving her clients over $1 billion in taxes. Shauna brings not only her expertise, but also the touch of the unexpected to our discussion today. So get ready for actionable insights and a glimpse into the person behind the financial wizardry. She is also known as the tax goddess. She has 3 books out there that are bestsellers. She's been on the cover of Entrepreneur and Forbes, as you can see in her backdrop if you are watching this on YouTube. But guys, we're going to cover 3 main areas today. We're going to talk about the overlooked tax deductions for entrepreneurs, how to balance your personal and business expenses, and then we're going to talk about how you can minimize the tax liability and maximize the savings. So Shauna, without further ado, you know what I want to say? I'm so tempted to say it. Show me the money.
I love it. I am 100% in to show you the money. That needs to be in every opening ever. Thank you. I love it. Well, where do you want to start with showing you the money? There's like 10 million ways to skin the cat. I'm in. Let's go.
Well, hey, let's roll up our sleeves and get started, because I'm pretty sure the Work and Live It Own It audience wants to know how to save some money as well. So can we talk about the overlooked tax deductions and what are some of the most overlooked tax deductions that we as entrepreneurs should be aware of when it comes to optimizing our returns?
Absolutely. So there are so many of them. So let me start with what we consider to be the low-hanging fruit. Now, I'm going to explain a concept here before we get into the strategies, because it's going to be important for each listener to determine which strategies they want to take and which ones maybe they don't, okay? Because in our world, we have something called the aggression scale. So 0 to 10, 0 meaning the IRS never calls you never ever, except for a random audit. Can't do anything about that. 10 mean we're all going to jail. So very important, right? That face, right? Nobody wants to go to jail. I'm a redhead. Red and orange do not look good together, right? Like, not something you really want to do. So when we talk about strategy, it's very important for the individual, for the taxpayer, to understand, well, where do they sit on that scale? Now, if 10 is we're all going to jail, 9 is we're basically Al Capone, okay? We're doing shady stuff and hoping we don't get caught, right? And then an 8, which is the highest level that Tax Goddess as a company is willing to go to. An 8 means you might get a call from the IRS, right? But you have all the backup, all the documents, everything. You got, here's all the records, right? And they basically leave you alone, okay? So it goes down in risk. Now, the reason why I bring up this aggression scale is that most entrepreneurs, when we ask that question, they're going to be at like a 7 or an 8, right? I don't mind if the IRS calls me, or I really don't want that call, but like push the envelope, right? I don't want to leave any money on the table. I need every penny of my hard-earned cash to stay in my pocket so I can reinvest in my business, hire new staff, buy new equipment, like whatever it is that you need, rather than handing it over to the government. So as we talk about strategy, when I say low-hanging fruit, these ones are typically either a 0, a 1, a 2. This is the stuff that every business owner should be doing, right? But often you have a traditional CPA. Now, let me back up. I am a CPA, master's in tax, certified tax coach, certified tax strategist, right? I specialize in tax strategy. But many people have a traditional tax preparer, traditional CPA. If you were to ask them where they are on the aggression scale, you can't do that. There's no way, right? They might be a -2 on that scale, okay? And so especially for my entrepreneurs, especially when you're in the first 5 years of business, you're just kind of starting up, you're really kind of getting your feet under you. Often you'll be with a CPA that maybe did your personal stuff for a long time. They don't really understand business 100%. They're not specialists in it. So I always really like to bring up this idea of aggression scale, because if you're thinking about you and you're thinking about your CPA and where are those levels, if you're a 7 and even if they're a 2, there's a huge gap of what you could deduct that they won't let you, period. They don't want to put their name on it because they don't know about it. So we'll hop right into strategy, because I know that was the question, but I wanted to kind of lay that base layer. So does that make sense? Am I explaining
it
well?
does. It does.
Yeah?
I don't want the IRS knocking at my door, but I also want to save money. I'm pretty sure like most entrepreneurs do.
So you're going to be a classic 7. Right? An 8 is I don't mind a call. A 7 is I really, really don't want to talk to them. Like really, really. So 6, a 7, somewhere in that range. So perfect. Do you mind if I pick on you and use you as my example today as we speak?
Go ahead.
Oh, thank you. You're so sweet. Okay. So let's get into the meat and potatoes of this thing, right? So basic deductions that every entrepreneur should be doing that get commonly missed. Okay. First one, getting your kids on payroll. Okay, at this point for 2024, the total amount that you can pay a child per year that is 100% non-taxable is almost $21,000. So if you have 2 or 3 or 4 kids, you can wipe out $20, $30, $40, $60, $80,000 worth of income. One of my favorite stories is I've got a client with 11 children. There's 8 of them that qualify, because there are qualifications here, and I'll go over that in a second, that qualify for this deduction. So 8 times 20,000, every year the family gets to take home $160,000 completely tax-free. And that money can be used on anything for the kids, because kids, of course, are cute. They're also often very expensive, right? Mm-hmm. So private schools, or getting an iPad for school, or their first car at 16, karate lessons, swimming lessons, music lessons, daycare, camps. I mean, you name it, right? It's kids' money. It can be used on anything for the children other than food, clothing, and shelter. So unfortunately, you cannot rent the room in the house to your kids. They cannot pay you rent for living in your house. It doesn't work. But let's talk qualifications. So child needs to be at least 7 years old, okay? And they need to be doing a job for your business. So that could be sweeping, that could be running your TikTok profile, that could be doing your SEO, that could be driving you. I have some of my parents that have their 16-year-old get practice driving with the parent in the car and the parents on the phone making calls, trying to close some deals for their business, right? So it could be absolutely any job that the child can in fact do for you. And you do need to pay them whatever reasonable wages are for an adult, for somebody else that you would pay to do this job. So if an Uber driver makes on average about $30 an hour with tips and everything else, you could pay your child $30 an hour to drive you around if that was the use case. So it's a great deduction.
Okay. What about spouses? If you don't have kids, can a significant other, spouse, anyone, can you use that as well?
Yeah, well, so spouses are kind of a weird case, because yes, absolutely you can pay them. But if you file joint, which most spouses do, that income is going to go out of your business and right back onto your tax return, right? So it really doesn't make a major net effect, but it does work with any other family member. So if you're taking care of nephews or nieces or grandchildren, we see this a lot actually with grandkids. If you are, let's say you have an uncle that always kind of needs a little bit of spare money, and instead of taking personal funds out of your pocket to help him out, he's on the payroll and he's doing a job for you. Now you get a business deduction and the uncle gets help. So lots of different options on who you can pay. Now, when a child is more than 18 years old, that $21,000 limit effectively disappears. So a lot of our parents will increase the amount that they're paying their kids when the kids go to college, and the kids now need buku bucks to pay college fees and books and tuition and all the rest of this kind of thing, right? We've got some parents paying their kids $120,000 a year, and all of that money is going to the college, right? So, but at least your business is getting a tax deduction. Yeah, going to college, right? Yeah, it's expensive stuff these days. Yeah. So, I really like the paying the kid thing, but you're right. Not everybody has kids. And so I'll use a perfect example. We were chit-chatting before we got on today. I have 5 dogs. Now, most people think, oh, that's nice. 5 dogs. You can't write them off on your taxes. You can if they serve a business purpose. There's a very specific rule. I would love the help. Now, unfortunately, you have cats. Cats don't qualify. I'm so sorry. Cats don't qualify. Dogs qualify. I know. It's not fair. I know. But with dogs, if you have a business and the dogs provide a business purpose. So in my case, I'll use myself as the example. Okay. I have clients come to my home all the time. We have a business meeting, we have dinner, maybe I have a vendor that comes over, does a presentation, like whatever it is. I have a mastermind group. I have staff that come to my home, right? So I have a lot of business use in my home, okay? Well, in my home, I also have client information, which needs security. And I promise you, of the 5 dogs, 2 of them are German Shepherds, 1 is a Great Dane Cane Corso, and the other 2 are basically boxer mixes. So they meet the qualifications. We'll talk about qualifications here, but I have had multiple people tell me when they come out to the house and they see 5 dogs in the window going, who are you, right? Talk about security. No arguments, okay?
Well, look, where I grew up, if you got German Shepherds and pit bulls, yeah, they're security. They're not the warm, cuddly kind of pets.
Nope. Now, I will say, and I don't know, I should put this on public recording, but my big boy German Shepherd, who looks all big and mean, is the biggest floofball in the whole whatever, okay?
Oh.
But I'm pretty sure if you tried to do something against Mama,
right.
an issue. So, but let's talk qualifications, okay? So, because you actually brought up one of the qualifications that a lot of people don't know about, pit bulls, okay? So the 3 main qualifications from the court case, because this came from a very specific court case, the dog's shoulder needs to be taller than the height of your knee, okay? So a Chihuahua, even though they're the most vicious dogs on the planet, not going to qualify, okay? Just sorry, not qualifying, okay? However, a pit bull, sometimes pit bulls are wider than they are tall. You know, they're the big chunky ones, right?
Yes.
Pit bulls, there are certain breeds that even though they're not tall, they will qualify. And pit bull is one of them, okay? Because as you said, ain't nobody messing with a pit bull, right? Like, it's not happening, right? Mm-hmm. So that's the first qualification. Second one, you got to have a business purpose, right? If nobody's coming to your home and you don't take the dog, some people will take the dog with them to jobs, right? Mm-hmm. If you're a traveling courier or a signing, a notary, something like that, and you take the dog with you, security, that'll work, okay? And the third bit, so business purpose, height, right? And the dog has to have some training. Now, that's a very vague word, right? So basically everybody kind of agrees, sit, stay, come. It doesn't have to be Schutzhund or like any of the super fancy training, but sit, stay, come, basic training. Now you have a massive deduction. Now, as I'm sure you can guess, with 5 dogs, my food bill is a little much, especially with big dogs, right? So, yeah, depending on what kind of dog you have, depending on how you use the dog, as far as with relation to your business, that would give you a write-off. It would include food, grooming, vet bills, right? Toys. My biggest dog is a puppy, and she is destroying every toy in about 10 minutes flat. So, little bit of a bill with that, So this is another tax strategy that a lot of people have dogs. Nobody's ever told them this. They had no idea, right? So
you can't get a tax deduction for stress relief because, cats are great stress relievers,
Ooh, okay, so let's talk about the medical end. Now, actually, maybe. Okay, so here's the deal, okay? Mm-hmm. You can have a service animal. That does exist. And I have seen crocodiles as service animals, which that would not be relaxing to me. I get it. I understand the faith. I know. Okay. But there have been crocodiles. There have been there's all sorts of birds and hamsters and ferrets and cats and dogs.
Guinea pigs.
Right?
Yeah.
If your animal can qualify as a service animal, yes, you can. So maybe with the cats. Mm-hmm. But with that, you're going to get a medical deduction and not a business deduction. Right. Okay. And the major difference, right? Yeah. One, medical, you may or may not have enough medical expenses to beat the 10% of the AGI limit. Mm-hmm. Maybe not. Okay. And two, certainly if it's a business deduction, you're not only saving income tax, you're also saving self-employment tax, which is an extra 15.3% on every dollar of profit that you make. So it almost like double dips on the taxes if you can get something to be a business expense. Ordinary, necessary, and reasonable are the three words that the IRS applies to every expense. So is security ordinary, necessary, and reasonable? Yep, right? So, yeah.
Okay. Wow. Guys, if you have dogs and you got, I don't know, Rottweilers, German Shepherds, Pit Bulls, Great Danes, I guess you guys got security. Especially if you have people coming
All
to
about
your
the
home,
security.
right? If you've got people coming to your
Absolutely.
home, if you got kids,
Yes.
up
But
to what,
especially if your
18?
kids are your employees.
Right. And you
Well,
said up
yeah.
to
So if your
18.
kids are your employees and people are coming up to 18, you can get that
Mm-hmm.
$21,000 completely tax-free. After
Right.
18, they do have to start paying like self-employment tax, and there are some taxes, but
Mm-hmm.
depending on how much income they make, a big portion may still be untaxable. So,
Okay, so I don't get tax breaks on that one. All right, that's fine. But hey, if you guys fit into these categories, that's great, guys. And I hope you all by now are downloading this episode and making sure if you're not driving, and because we don't want you distracted while you're driving, make sure that you're taking notes, okay? But don't forget to download this, share this with your other entrepreneurs, because we're going to delve in a little bit more. Shauna and I, we're going to talk about balancing the personal and business expenses. So maybe I may fall into this category. I don't know, but how can we as entrepreneurs effectively balance personal and business expenses for tax purposes, ensuring that we make the most of the available deductions? So say, for example, years ago, someone said, if you're buying clothes for work, that could have been a
let's talk
tax
about clothes.
deduction. But then I was told years
Yeah.
later, no, it's not. So, you wear clothes, it's a
Let's talk.
necessity.
Well, and that's really what the IRS went after. That's what the IRS went after. So let's back up. There is a specific clause, okay, and it's more court cases. A lot of deductions are based on court cases because the law is very simple: ordinary, necessary, and reasonable for the job you do. I mean, period. That's the law. Those three words: ordinary, necessary, and reasonable. It's a very simple law. So when we start to talk about can we take dogs and kids and clothes and medical and all these things, then it becomes court cases, really, right? In this case, they won because of XYZ set of factors in the scenario. So one of the court cases that has come up is specifically related to actors, on-screen personalities. Okay. So I'll use myself as an example, okay?
Okay.
As a CPA, as a tax strategist, I need to look professional, right? I mean, I couldn't come in with my hair sticking up and like all over the place, right? I have to look at least somewhat professional. But my job and people paying me money is not 100% based on my appearance. It's just not, right? I mean, I could look a little bit more slobby or a little bit more professional or whatever, right? Like, whatever. People are hiring somebody like me for my knowledge, right? For the ability of my company to save you a ton of tax. So the appearance is not really such a big thing, okay? But if you're an actor, your appearance is everything, right? If you need a six-pack abs to be on TV to film whatever movie you're doing, right? You're playing the new Spartan movie or whatever, you need to look like a Spartan. So the food you eat, the clothes you wear, the personal trainers, the workout shoes, like all of those things for you are now ordinary, necessary, and reasonable because you couldn't play that role if you didn't look a certain way. I know. You're making the face at me, right? So how does that help the rest of us, right? Because the rest of us get to look like poor slobs. We're not professional actors, right?
Well, no, we're not going to look like poor slobs, but I'm just saying, I mean.
Just saying. Well, but this is the question. So the IRS in the court cases, the IRS has expanded these indicators to other people that are commonly visual. Okay. So TV anchors, for example, you and I are both right now are visual, right? And this could get a client for me or for you or more people to join the podcast or whatever. The visual here is important. Now, the one thing about clothes, because you hit on clothes specifically, okay? So makeup, hair, nails, whatever you need to look professional when you're doing presentations or whatever, this, yes, you're good, okay? Things like dry cleaning clothes, right? So let's say you have a suit that you're going to do a presentation in and you get the suit dry cleaned, before you go on the presentation. Totally good. You get your hair done before you go on this presentation or to go sell a client. 100%. The IRS is all good about that because if you sell that client, you make money, they get a cut. So they're good about that, right?
So back up just for a moment. I don't want you to lose your thought.
Yeah.
So what you're saying is if I get facials done because I'm visual and that may lead to a client or keeping my hair done, and that helps me get clients or even sponsorships, then that could potentially be a tax deduction.
That could work. Now, this is probably, because we talked about 7, 8, 9, like where are we at on the regression scale? This is probably like a 7.5. Okay.
That's where I like to stay.
The IRS's argument is you cannot deduct anything 100%, right? So let's say you buy a new jacket. Okay. 50% of the time you wear it for business. 50% of the time you wore it out for dinner with your husband or whatever, out with your friends, whatever. Okay. You could deduct that jacket 50% because you're using it for business 50%. Okay. So yeah. So when we go to things like the hair and the clothes and whatever, right? It's really one of my favorite tax sayings ever. Okay. Pigs get fat and hogs get slaughtered. Okay. So if you're going to buy something, right? The famous example is the Rolex. Right? Okay. Can I write off the Rolex because I'm on YouTube and I'm a star and I have to show signs of success, right? I have to be flashy and you see them like posted on the Lamborghini and like in front of the big house and right, like, and it's not even theirs, they're renting it, but whatever. Okay. That's a whole thing in the drama right now, but whatever. So, are things like that a deduction? Where the court cases have come back, right? And so this applies to what you're saying. Where the court cases have come back has said, listen, if you can prove that you got that client because of the Rolex you were wearing and not because of your knowledge, we'll give it to you. Okay. So how do you prove something like that, right? Let's take the hair and the jacket and whatever. Did you get a written testimonial from your brand new client or brand new sponsor? She came across as so professional and, I was just so impressed with that diamond Rolex that she was wearing, and that just really cinched the deal for me.
Yeah, no, nobody's really going to say that.
So this is where the IRS just gets really weird about things, right? Okay. Because, and do you mind, can I be a little risque? Just a little tiny bit? Because there's a very famous case that specifically relates to this.
We're real on here.
We're real. Go ahead. Okay. Go ahead. So there's a very specific case and it's famous and it ties in exactly to this. Okay. So everybody knows what a professional dancer is, right? They're up on stage, professional dancer. Okay. There was a court case where this professional dancer had some physical enhancements made. Okay. And so she went on stage, she made money, right? And she deducted them. She deducted them because to her, ordinary, necessary, and reasonable. If I have these enhancements, I'm going to make more money and the IRS is going to get a bigger percentage of the money that I made, right? Because I made more, they get more, everybody's happy. Okay. IRS tried to fight her on it. Okay. And they said, no, that's a personal thing. Absolutely not. It has nothing to do with nothing. Right. And everybody in the courtroom made the face you just made. And so the judge turned to the IRS and said, so I'm sorry, did you or did you not collect more money because of these enhancements? And well, yeah, right. And the judge said, well, then why are you complaining? No, it is clearly, obviously, ordinary, necessary, reasonable for her, specifically her job, to have those enhancements, to make more money, to pay you more. So drop it. So it gets very funny and very specific. And, I would suggest, right, number one, look at where you're at on that aggression scale. That Rolex is probably an 8, 8.5. Okay. Right. The Rolex. Okay. But if that's who you are as a person and you are willing to get 15 testimonials from 15 clients in writing and get them to stand up in front of the IRS and say, yeah, that person was showing signs of success. And that's why I went with that person. We see this a lot with business coaches specifically, right? I have all this success. If you want to be like me, do this, right? And this is what you are. Or with salespeople, specifically, we say with salespeople, right? Because if you show up, we see this with cars a lot, real estate agents, right? If you show up in the beat up Honda, right? If you show up in the beat up Honda versus if you show up in the Lexus or in the Mercedes, what kind of level of respect do you have from the people that you're dealing with?
Right. That's why I was asking you, because as a realtor, when I'm out, sometimes I have my husband drive me. That's why I was asking, could I pay him and that be a tax deductible? The clothes, could that potentially be a tax deduction as well? Because yes, you do have to look a certain way. Not saying that you got to look très chic or anything like that, but you do have to be professional.
You have to be professional. Well, and you have a couple of pieces here, right? With the clothes. Let's say we really wanted to hit on the clothes. 20 years ago, one of my very first clients ever, okay, when I opened my own practice 20 years ago, tax got us returned 20 years old this August. So one of my very first clients, thank you. One of my very first clients said, I want to write off all of my clothing, all of it, socks, underwear, undershirts, all the things. And I'm like, I mean, who's going to see your undershirt, right? Like, what are you doing? Like, flash out? What are you doing, right? And he said, well, no, I want you to figure out a way to do it, right? I said, okay, well, I mean, if absolutely every piece of clothing you own is logoed with your company logo, it now becomes marketing and advertising. And I was kind of half joking. He came back, sent me a photograph, not on him, thank goodness, like, you know, on a counter or whatever, of a picture of the top of the band of his underwear with his logo on it. And I'm like, whatever, okay, if that's if that's what you want to do, okay, all right, fine, right. So I really, and you know, paying the husband, I mean, the good thing about paying the husband, so my previous statement holds true. If your business pays him, he now has a business. If you file jointly, the income is still there, right? But if he doesn't have a business, if he's, let's say he's a W-2 person and he doesn't have a business, okay, now he has a business, which means whatever his business is, Uber driver for the family, right? His business can now write off reasonable expenses for him and his business, which might be different. So
does he have to be a sole proprietor? Does he have to have an LLC or S Corp?
Good question.
In order to do that?
You do not, in the U.S. law, you do not have to have an entity to be able to take tax deductions. Okay. So he could just be a sole proprietorship, you know. I would recommend, like if we're picking his specific case, I would absolutely recommend that he gets some other clients. Not just you, otherwise it looks a little weird, right? So if you can drive friends to the airport, if you can drive friends' kids to somewhere else, you know, whatever, right? Get a couple of clients. Of course, track all of the normal stuff that you need for a business. Income, expenses, gas, repairs, maintenance, insurance, like all the things for the car. Yeah.
Okay. All right. Wow.
Great question.
Okay. So now we're getting ready to move in to minimizing tax liability and maximizing our savings. So Shauna, in light of recent tax changes, and we're probably going to see some more next year,
of course,
or incentives, what are some strategic moves that entrepreneurs should be considering to minimize their tax liability and maximize the savings?
Absolutely. I'm actually going to hit maximizing savings first because it will help with minimizing the taxes. So one of the things that I highly, highly recommend, there is an accounting system called Profit First. And it basically says that if for every dollar that comes into your bank account, you are going to decide ahead of time what profit you are willing to accept for all your hard work. Okay. So generally, when you're a small business, so under about $1 million worth of revenue, those percentages work out to be about 10% owner's profit. Okay. Like I'm not even going to do this business if I can't at least make some money for me, right? Typically you would put about 20% into savings for taxes. We're going to come back to that here in a second. So we got 10%, 20%. So we're at about 30. Okay. And then I like to tell people to add another 10% for fudge. Something happened, something broke, I need a new laptop, it fell in the sink, you know, like whatever, right? Something happened. So about 40%. Now, what you're supposed to do with this is that for every dollar that hits your bank account, you would set up, in this case, three separate accounts, right? We're putting 40% away into 3 separate accounts. those accounts would be at a different bank, completely different bank. So if you're banking with Bank of America, these 3 accounts would be at Wells Fargo. Okay. Because what you're trying to do is move money out of sight, out of mind. If your main operating account is Bank of America, and you put these are really savings accounts at Wells Fargo or whatever banks, right? But you put them at Wells Fargo, okay? Your brain looks at your bank account of what's left. You only have 60% left, right? That's how much I can spend. That's it. When I'm out of my 60%, I'm out. I'm done. Does that make sense?
Right. So overall, and I've heard some people say have at least 8 different bank accounts. How many bank accounts, different accounts, would you recommend
Yeah.
a business owner having?
Yeah. I when you get to 8, and I'm a CPA, right? It's too many, right?
Okay.
It's too many. For me, 8 is too many. Okay. I understand what people are saying because, you really do want to segregate. Like, let's say you have a goal. I want to take my family to Disneyland and that's going to cost $10,000. Okay. I don't mind having goal accounts, right? I'm just going to stick money in there until it hits 10,000. I'm going to stop. So you can have as many of those as you want. That's up to you and it's custom to you and whatever, right? For me, as a standard baseline of a business owner, there's your main plus 3, right? 1 for taxes, 1 for you, and 1 for just fudge, right? Oh, fudge, something happened, right? And it's like an emergency fund.
Emergency fund, yeah.
Yeah. Because anything more than that, and the system becomes really complex to try to run and manage, and who's moving what, and all this. We've just heard of a really cool app that's coming on the market. It probably won't be out until later in the summertime, but it's called Cash Goblin, and it allows all of these transfers and stuff to be automated. So keep your eyes open for that, Cash Goblin. But I like 3 plus your main checking account.
Okay.
And the reason, remember I told you we are going to come back to that tax account, that 20%. Okay. If you are a business owner and you do all the tax strategies you can, okay, let's put it this way. If you do all the strategies you can, the average tax rate is about 6%. 6. Okay. So if you've put away 20, right, and your tax rate is 6, okay, and this is the new book, by the way. If you save 20 and put away 6, you have 14% to invest in a new rental property, a tax strategy that goes above and beyond, put money into retirement. You can actually take that money and invest it in something. And for a lot of business owners, I think that's one of the biggest pieces that gets missed is we all work so hard, like grind and day to day, and we're running, we're moving, whatever, right? And at the end of the day, if you run your accounting, dollar in, spend all the money, and I get whatever's left, sometimes there's nothing left because I thought I had to pay this and I thought I had to pay that. If you switch that method and you put the profit first, and this all comes from Mike Michalowicz's book, Profit First, okay, and he's a lot more rigid than I am on my accounts and all that kind of stuff. But if you go with this more profit first accounting and your money is at a totally separate bank and you only have 60% left, you become really frugal really fast, right? Because you're like, I don't have the money to buy that cool new iPhone. I guess I'm going to have to stick it out with the old iPhone for another year or whatever, right? Because this is how much you can spend. And so you are always guaranteed, unless something catastrophic happens, right? You are always guaranteed to have the money to pay your taxes, to invest in things, to take home, to pay your own bills, right? You're always guaranteed to have the money if you do it that way. So I love using this method. We use it ourselves and we have for almost 20 years and it's great. So.
Okay. So 4 accounts.
Yep.
1 for the business.
Yep.
1 for taxes.
Yep.
1 for you, because you should be paying yourself first.
100%.
Right?
Yep. And 1 for fudge.
Well, yes, the emergency plan.
Yes.
So out of the business one, that's where you're paying your employees if you have employees, right?
Yep.
And then for profit, what was the percentage for profit again that you should be paying yourself at least with?
Yeah, normally I start with 10%. What definitely tends to happen is that as you start to work this process, right? So I'm going to warn people right off the bat. The first 3 months, you are going to hate me. You're going to hate the process. You're going to hate profit first. You're going to think, because you're so used to just spending all the things. Okay. And so it really, this is kind of like a hard thing when you first get into it. Okay. But yeah, if you can start with 10, Now, some people don't make 10% profit, like their total profit is 2%. Okay, do 0.5%.
Okay.
Do what you can to start, because I'll be honest with you, it's not so much about the amount of money that's moving, it's about building the habit of moving the money, of getting it out of sight, out of mind, to another account. I'm not allowed to touch that. Like it's not my money, right? Like
Right.
the tax account. I always tell people to label it the IRS, because if you put those two together, it spells the word theirs. It's not yours. It's theirs. Okay. So, there's so many ways. Money is such a psychological trauma for so many
Mm-hmm.
people that, if you can just get in a very simple habit, right? 10%, just 10%, right? Because 40% is a lot to start with right off the bat. 40% is like, for a lot of people, it's too much. Start with 10%. Split up 10% into those three accounts and just start raising it as you sort these things out, or as you make more money. Don't spend more, make more money, and then you can move more, right? So,
Right.
yeah.
Well, Shauna, you have definitely worked us on how we should work it, live it, and own it in our business. You checked all the 3 boxes today. We talked about overlooking the tax deductions, how to balance your personal and business expenses, how to maximize the savings first in order to minimize the tax liability. I was listening, I was paying attention. And guys, we're going to continue our conversation, Shauna and I. But if you haven't signed up for my newsletter, like what in the world? I need you to head on over to workitliveitownit.com and sign up for our newsletter, because we're about to have a podcast after party where I'm going to continue the conversation with Shauna. She's going to give a little bit more insight and detail. But again, you got to be a part of my newsletter, the Work It, Live It, Own It newsletter. And if you're not part of that already, what in
Go
the
sign.
world? What's going on? Let's go. Right, Shauna, say it again. Tell
Go
them.
sign up. Go sign up. What are you
Go
doing?
sign up,
Go.
because we're going to have a podcast after party. So, but before we go, for the podcast, for the main part of our conversation, just a quick tip time. So beyond the number, Shauna, so
Okay.
people can get to know you a little bit better, what is your favorite part about helping entrepreneurs with their taxes, and how does it impact their lives?
I love it. Well, my favorite part is the impact that it has on their lives. Okay.
Mm-hmm.
Because so many people are terrified of taxes. They think if they even deduct the pen wrong, they're going to get in trouble. Right.
Right.
So education, making it happen, like actually implementing it, getting that cash back in their pockets so they can do what they think is right, rather than giving it to the government and hoping and praying we like the laws they make. So, I really, for me, it's all about helping the little guy, I guess. So
Great. Thank you for sharing that. So again, guys, I need you to head on over to workitliveitownit.com and sign up for the newsletter, so that way you can check out the podcast after party. And Shauna and I are going to continue our conversation. I'm going to find out a little bit more from Shauna about how she got on the cover of Entrepreneur and Forbes, and any other quirky and unexpected moments that you may have had in your journey as an accountant. But most importantly, guys, I want to keep this conversation going with you. Drop your questions in the comments below if you're checking this out on YouTube. Hit me up directly on my email, info@workitliveitownit.com, or you can head over to Instagram and send me a message there to share with me about your successes or effective tax strategies, or questions that you may have for Shauna, so we can go ahead and direct those to Shauna. Shauna, we're going to put links down below to your 3 best-selling books in the show notes, so that way you guys can check out those books as well. Well, that wraps it up for this particular episode of Work It, Live It, Own It. And again, don't forget to head on over to Work It, Live It, Own It and sign up for the newsletter for the podcast after party. All right, guys, take care.